I actually want to talk about Bitcoin. Like it's been so resilient. It's starting
Yeah.
to tick up now. It's almost like it's really turning into digital gold now. Like that's the best way to put it is this is what digital gold should act like. Like you have that finite supply where a majority of the supply is actually just being held. No one, like, it's just being untouched. There's only a small portion of Bitcoin that is actively being traded. So I think that also just has an effect on the price holding up so well. A lot of people are just diamond handsing this, and that's exactly how you would expect a finite resource to perform. So I wonder
Yeah,
if, like,
so
are we entering the next phase of Bitcoin where it actually is digital gold now?
possible. Obviously, you can't discount anything, right? But at the moment at least, it is still more correlated to tech than it is to gold. We're seeing some lifting in that gold correlation, starting to become more correlated to gold on a shorter time frame compared to tech, but it's still leaning more towards that tech correlation. I think this is obviously somewhat of a signal, but I wouldn't take this as a like we're all in the all clear, because I think that there's a very specific relationship between Bitcoin and gold that makes it a differentiating asset, right? So with gold, it's very tangible. Not only, and this is not in the central bank in the tense, like in the scope of a central bank, like it doesn't really matter because no one's touching it, right? Like if it's Bitcoin or gold, it's just sitting in a vault, right? It doesn't make a difference. But for the general population, there is an opportunity for Bitcoin to eventually be treated as gold. But the issue is that it's not tangible, right? And when people think of a crisis, the typical move is hard assets, something that you can have in your hands, right? Like if they need something today, it's something they can hold in their hands. And that's typically has been gold, or US dollars. But, obviously the whole political dynamic right now, not the best for dollars. We'll see what happens. I do think dollars rebound, but that's outside the scope of Bitcoin. I think that the signs that Bitcoin is telling us or is showing us at the moment is a sign of resiliency, but it's not so much a sign of robustness like just yet. It's not a signal that like you need to be max bidding Bitcoin here because it's going to be the next it's going to go to all-time highs and match gold. I think that you could take strategic positions with it if you like. You can go along with keep stops tight, try and ride some sort of reversal, but from the tactical perspective of how we own it, I think that you're going to need Bitcoin to prove its resiliency beyond not just going down a lot in a risk off environment, essentially hedging a risk off environment. I think if you get that type of resiliency at some point, that will be what solidifies Bitcoin's nature as a more anti risk asset. Like, for example, if Bitcoin would have accelerated up, not down on the tariff news, pretty much like gold, if it would have accelerated like gold, I think that that would have been a more cleaner and more robust signal that you're dealing with a more of an anti-risk asset than just a lower correlated risk asset that how it's been trading lately. So I think that's where we are right now with Bitcoin. It's more of still in the wait and see phase. The other issue with Bitcoin is in the past it's decoupled and then just fell off a cliff,
Yeah,
right?
that's
Like
true.
that.
Like
So
at the end of the day, we also still haven't had a recession. Technically, we are not in a recession still. We got to see how Bitcoin performs in an actual recession. Like,
yeah,
does everything go out the window once you hit a recession and Bitcoin just craters like every other asset?
yeah, that's probably the biggest signal. Obviously, I'm not waiting for a recession. I don't hope a recession happens. They're never good. But if a recession were to happen, that would be the biggest signal, in my opinion, as to whether Bitcoin is a resilient asset or an anti-risk asset, or it's just a risk asset being um, masquerading around as somewhat anti-risk just because its correlation has been falling, but it isn't necessarily no longer a risk asset, right? And then again, like Bitcoin likes to play catch up too, where all it takes is a couple, like realistically, if Bitcoin went from 84K to 74K, I don't think many people would be that surprised. So I think that the biggest issue right now for Bitcoin is that we gotta let it play out and let's analyze how it reacts under real stress, and from there we can make the educated bet that maybe this is no longer a risk asset.
Yeah.
But let's actually talk about bonds this week, right? So
Yeah, so we finally got that bounce in bonds. Still has the weighted vest though. Like even throughout this bounce, like it I've just been looking at it all day and it's not acting like it should. Like after that kind of liquidation cascade, we should have bounced up to mid vamp very quickly.
yeah, no,
Like
and
it just
yeah, no,
struggled. It was just barely grinding higher, so there's something wrong. There's something broken with bonds at the moment.
yeah. I'm thinking that the initial move lower was some sort of liquidation cascade. Obviously, people getting liquidated right back, left and right, and then something shifted here as we tried to rally. It, again, that weighted vest that we were talking about. It almost back over here at beginning of April. We had these overnight moves that gave the illusion that the weighted vest was no longer on, but the regular trading hours kind of disproved that, and then this whole like liquidation phase down really just put that to rest. This thing's trading like it's got lead on its shoulders, and I think that until that kind of resolves, it's going to be tough out there for bonds. In reality, it's going to be tough for the administration to get lower rates, because it almost seems like, if we look at it from a perspective of long end yields, they have like this drift. Like we spiked all the way up to the Trump inauguration level in the 30-year, and we haven't really been able to break. It's almost like we ripped up to it, fell, but it almost feels like we're gravitating back towards it, which makes me think like the market is trying to signal something, at least maybe to the administration, that um, they have to reorder their priorities if they're going to really, if they're going to really deserve lower rates. So I think we're kind of stuck in a rock and a hard place with bonds there. It's a battle right now, and it's becoming a little bit more political. And I think that probably has to play out before the next bond trade emerges, in my opinion.
Yeah, like there really has not been any progress on the deficit at all. And
No,
like
no.
bonds aren't really going to move where they need to move to be that recessionary hedge unless that deficit starts to get tackled.
Yeah, I mean, I think the deficit so I have this interesting take on the deficit, right? And I think I put something up on it on X about it, but ultimately what I think can happen here is this obscure situation where the government is running a fiscal it's excuse me, the government's running a deficit right now, and we're having a positive output gap, right? So we have we're basically running above capacity in the economy, and realistically, for you to get a recession, you have to fall below that positive output gap. So if you think about it like this, if the economy is running above potential, for us to get a recession, we need to start running under potential. And there's a wide cushion to which you can fall before you go into be running an economy under potential. So think of it like there's a wide cushion that they can absorb. So there's this situation where the economy can theoretically slow, but not enough to run under potential, right? So not enough to run into recessionary territory, just basically come in a bit. And this action of coming in will allow the Fed to be easier on policy, okay? Because the reason they have to hold so high and be so restrictive above the rate of inflation is because the deficit is so large, and that output gap is, plus almost 2%. So the economy is theoretically running 2% above potential. If the Fed wasn't as restrictive, that would show up in inflation. So the Fed's basically dampening that surplus effect on growth. And as that effect comes down, the Fed can ease policy quite a bit to where we'll have to see. And if they ease the policy down they ease interest rates down, and then they reduce that. The government reduces that output gap. Long story short, you can have a situation where the Fed can lower rates without a recession, and in turn, taking some points off of the deficit due to a reduced interest expense, right? Because the interest rates come down, so the expenses on debt drops as well. And we're not talking severe. We're not talking about balancing the budget here, but you can kind of get this effect where you don't really have it hit the tax receipts, right? So you don't have that revenue side falling apart, but you have net interest expenses, which make up 50% of the deficit value, take a hit. Maybe if it's only 25% haircut, right, on net interest expense, well, that brings the deficit down into the fours or fours to fives, right? Or pretty much fours from six.
Yeah. I
So
wonder if that slowdown, that's essentially a slowdown regime.
essentially, yeah, it's not a recession because in that scenario that I'm explaining, the output gap, right, is not necessarily falling below zero. Let me see if I can pull that up here. So here. So this is where we are right now. As you can see here, if you take the estimates of real GDP, so the estimate potential, and then you take on what we're actually producing. Currently, we're running one as of last quarter, 1.85% above potential. I expect that this is coming down in the quarter one. I expect that this is going to retrace given the very hard hit to GDP estimates that we're seeing. Now, if this can come down to zero, as you can see historically, most of the time, unless the decline is rapid and we're doing like economic implosions, recessions don't really print until output gap is negative for the most part, right? And I think that this is the situation that we're running into right now where output gap can fall, even if it's the 2022 levels, right? So you have this output gap fall, and it allows the Fed to take the grip off the or off of rates and loosen the economy a little bit. Because if they cut rates now and the output gap has not fallen, what's happening is this is basically an indication that there's excess inflationary pressures in the system that the Fed is putting a cap on. So if the output gap falls, the Fed can release some pressure, in turn bring rates down, right? In turn, there'll be some hit to net interest expenses, which in turn will help the deficit without necessarily crashing the economy and crashing tax receipts. And you have a little bit of a dampening on that deficit value, which I think the market would really appreciate if we can get that. This is again very obscure. How this happens, we'll see, but no one seems to be thinking about this or talking about this, which kind of makes me think it's one of those things that could possibly happen and nobody could see coming, which would be very interesting, obviously, if it does. But I think that this is a more of an obscure solution to the complex deficit problem we have. It's not a permanent It's not a permanent fix. Obviously, spending needs to get cut as well. But I think that this would be obviously a positive signal for the market and for the administration to see deficit values lifting a bit.
Yeah. I wonder if XLU is kind of giving us a hint at the slowdown. If you look that up, like it's been holding up very well throughout all of this.
Yeah, honestly, you know what? You know what else is? Pretty much all defensives are acting defense. So interesting you say that, right? In this environment that we're having right now, pretty much all defensives are acting as they should, except for bonds. Literally, gold's working, right? Like if you look at like IAK, right, which is like insurance. What are we down for the year here? We're up 1.7%, 1.8% on insurance for the year. Makes sense, right? Look at XLU, 2%. Look at consumer staples, 4%, right? Like these are showing signs of resiliency. And then you look at TLT, and TLT for the year is down at this point. So obviously, like something is wrong in the bond space, and we hope it gets fixed, but it doesn't necessarily mean we can't take defensive slash slowdown plays if a slowdown emerges. XLU is probably the most promising one though that you were saying, because XLV, I think, yeah, XLV is just it's got the weighted vest on too, honestly.
Yeah, XLV is not
So
looking good either. But
XLV. So it looks
but that's a good sign. That's a promising sign that these defensives are holding up fairly well. That's they wouldn't be holding up fairly well if a recession was actually being priced in. Like
oh yeah,
this
no,
is more of a
yeah.
slowdown. pricing.
No. There's no recession being priced in right now. No way. Because if you think about it, if there was a recession being priced in, I mean, you'd see like this would never recover the way that it did. High yield spreads would just continue. Okay. I think even at that point, TLT would actually be getting a bid if a recession was really underway. I think what's holding everybody back on the recession and the market on recession is unemployment, honestly. Like if we look at the unemployment rate and we just look at where we are, I mean, we're not at new cycle highs theoretically from the lows. SAM rule is just far from being triggered. There's a lot of things against the recession call right now that could change in the next few unemployment prints. And typically, right, bonds will front run that action. So the fact that we're not seeing bonds like at the upper end of their range, like what we were seeing at the beginning of the month was more of an indication that maybe a recession is building. That's typically what happens. Bonds will start flipping trend, moving, grinding up, and then the data starts coming in, right? Now we're seeing the complete opposite. So I think possibly we're in a situation where the market's fully expecting more of a slowdown, and then some sort of reversal, or at least like some sort of unwind that's not recession based at the moment. But the thing about recessions are they come quick and markets react very fast to them. So um, if you're trying to time a recession, it's probably not going to be it's probably not going to go well, because again, um, in the situation where you have a real recession, things like IAK, insurance, utilities, that's a severe risk off event. They will get hit too. Like in a real recession, your only safety is TLT and gold, and maybe dollars. So the fact that gold is the only one that's actually working tells me that we are just experiencing more of a politically driven slowdown at the moment. Well, thank you guys so much for listening. If you have any questions, feel free to reach out to us on X at The Market Radar, or go to our website at market-radar.com.